This podcast is brought to you by the Wharton School at the University of Pennsylvania. Well, starting on June the 30th, the Securities and Exchange Commission began enforcing its new regulation best interest rule. The new rule has brokers now having to disclose any conflicts of interest in regards to investment opportunities for consumers. And while this is more disclosure than in the past, there's an opinion out there that it doesn't seem to restrict brokers enough. Tom Meyer is the CEO of Meyer Capital Group, and he joins us on the line right now. Tom, great to talk to you again. Hope you're doing well.
Hi, Dan. Great to talk to you.
So let's lay out the framework for people that don't know what this regulation best interest rule is. Give us the overview of it.
Sure thing. Think about it. This is a replacement for the DOL rule, which got squashed a few years ago, and the SEC kind of took the baton and said, okay, we want to try and make this a lot easier for investors to understand that everyone is more on a level playing field, everyone in our business, meaning the brokers and the fiduciary advisors, the fee-only advisors and the brokers, meaning that full disclosure that when a client or potential client enters into an agreement, that they are fully aware of the services that you offer, that any conflicts, fees, costs, everything is basically transparent and in a simple two-page summary that each investor now is required to get at the point of sale and also once a year. But I have to tell you, I mean, it's a great step in the right direction.
Yeah.
But to me, I think it would have been a lot better if each client at the point of sale had to sign this, so at least that we would know that they would read it.
Well, then that brings up the question, Tom, of kind of putting this in the lap of the client and whether or not they have enough understanding to be able to make that type of decision.
Right. You know, Wall Street has a habit of making things a little bit convoluted, shall I say.
Yeah.
And this at least is, again, a step in the right direction that it puts the onus on the individual investor, which it really should from day one, the responsibility for the individual investor to know exactly what they're getting involved with, how much money is coming out of their pocket. And it's only right to be transparent. I mean, it's their hard-earned money, for God's sake, and it's the least of what brokers can do to be on the same level playing field that we have been on from day one, is to be transparent with the cost and fees. And I don't begrudge anyone being paid. Everyone should be paid in this business. But quite frankly, I am so sick and tired of hearing, hey, I never paid X for this, or this didn't cost me any fees. There's no free lunch, and there never will be. So this is a step in the right direction. But you're right, Dan. This puts it in the lap of the individual investor yet again, that it's their responsibility to ask these questions.
And it's also the factor of the client understanding who exactly they're talking to, whether or not they're talking to a broker, an advisor, or a fiduciary, correct?
Exactly. I mean, focus group after focus group basically has spelled this out, that most individual investors think that a fee-only fiduciary advisor is exactly the same thing as a stockbroker selling a product. And it's been that way from day one. And it does get very, very confusing, for sure. But don't forget, in today's world, it's never been better for an individual investor as far as information on the Internet and as far as transparency. I mean, you know as well as I do, go back 20 years ago, and, I mean, mutual funds were at, 8% off the top, and people didn't even know that they were paying it.
Yeah. Yeah, so it's a much different scenario than what we saw many years ago. We're joined by Tom Meyer, CEO of Meyer Capital Group. So obviously we're 5 months plus into this pandemic at this point, and obviously I think a lot of people are like we were more than a decade ago with the Great Recession. They're concerned about their investments. How do you think people should be thinking about their investments right now?
Well, think about that. Like 2008, I mean, we have almost $5.5 trillion sitting in cash, earning nothing. It's more in a capital preservation mode because people got very antsy back in March. I mean, it wasn't a pleasant experience, and the quickness of this going from a bull to a bear market to a bull market, in my 38 years, I've never seen, such movement. And now that, clients have a chance to go ahead, or clients, individual investors have a chance to reflect on what just happened, they have to be very careful. They have to stay within their guidelines of their investment objectives and, most importantly, their risk tolerance, because let's face it, what's been moving in this market up until May has been controlled by five stocks, right? The FANG. And we have to make sure that individual investors don't go rogue and go crazy and buy all the stocks that have been moving, right, and make sure that they stay within their parameters and look to, my guess is they're going to be way over allocated to equities right now, way over allocated, especially to large cap growth. Now is the time to do rebalancing, and make sure that the monies are invested as per their asset allocation models, and not to get, again, going back to 2000, we remember how that was. We have now just hit the multiple on the S&P 500 is exactly or a little bit less than where we were in 2000 when everybody wanted the latest .com stock, and we know how that ended. So we have to make sure, and individual investors have to make sure that they're properly allocated as per their investment.
So are you seeing people, and are you hearing from other companies, other advising groups, that people, because they kind of see what's been going on Wall Street, I mentioned the S&P, hitting a record high. Obviously, the Dow has been very strong. And you look at some of the individual stocks, obviously people know what companies have been doing well during this pandemic. And obviously there's Tesla, which has been off the rails for the last few months as well. Are you seeing more investors that feel like they want to be more aggressive at this point? And in certain situations, it may be good and you might need to pull them back.
Yeah. Oh, absolutely. It's human nature, right? That's the way we're wired, and we have to definitely pull them back. You want to pull a little bit, fine. But to totally just, make your asset allocation and throw it against the wall, we can't do that. And the problem here is, when you look at the Robin Hooders of the world, which is the brokerage that seems to attract a lot of the millennials, is what I'm seeing as far as the speculation, whether it's Kodak or whether it's Hertz, going bankrupt and still charging, at $5 a share, or Chesapeake Energy. You look at it, a lot of people are getting hurt because they have no idea, how to put orders in, how to put limit orders in, if they put market orders in. Kodak, 2 weeks ago, Kodak, I think the trading was halted like 10 times. Yeah. And people just kept putting market orders in. And when someone thinks they're paying $30 a share, next thing you know, they're paying $60. So, we're getting to that speculative froth, if you will. And there's great value here. Don't get me wrong. You look at the value stocks that are still down double digits year to date that are yielding anywhere between 3 and 5% offer great value here. But right now, nobody wants them, which is a great time to look at them.
What do you think are some of the options then for those people out there that are carrying debt, whether it be their credit cards, their mortgages, whatever it might be?
Well, first of all, credit card debt is a no-brainer. When you're getting 0% in cash, you got to pay off those credit card debts that are running in some cases up to as high as 20%. You're putting 20% in your pocket if you think about guaranteed if you pay off that credit card debt first and foremost. But I think what we're running into also is conservative investors that want to have some type of return on their money, that have CDs coming due or bonds coming due that they were getting 3 or 4%. Now the bank is offering them 25 basis points. There was an institution that floated an 8-year CD at 1%. The 10-year bond is at 70 basis points right now, and the real rate of return on a 10-year bond has gone negative for the first time in history. So where do those investors go? You do have some alternatives, but you have to take more risk, and therein lies the problem. You have preferred, you can go into convertibles, you can go into high yield bonds through mutual funds that you can go to get anything, that will give some type of interest rather than 0 or 25 basis points for a 3-year CD.
So then what's the safe play right now?
For a conservative investor today that doesn't want to take any risk.
So then what do you think is the safe play right now?
Like what I just said, you can venture out, but it's got to be understood that there's going to be risk. Without risk, you have no chance of any type of return in today's market. I mean, you're losing money each and every day in cash, right? You're losing money each and every day in a 10-year treasury. So the Fed, and I'll blame the Fed here, is forcing the issue of assets going from what normally would be in safe fixed income investments, floating them toward more risky investments such as dividend-paying stocks, and which is all fine and good. You can get 3, 4, 5%, which is great if you can handle the risk, because that stock could be down 10% in a day or more. And then I think you have to look and broaden your horizons out to look at, as I said, preferred stocks and preferred or ETFs, dividend-paying ETFs, a basket of stocks instead of just one individual stock to try and limit your risk. But that $5.5 trillion eventually will go from that capital preservation mode into a mode of, hey, I want to get paid something in return.
You know, when the Great Recession occurred more than a decade ago, one of the things we talked about, a couple of years after that, was the push of many people who lost a lot in their retirement savings, to stay on and work longer. And I'm wondering if you're seeing, any of that, even at a minute level, or is this one so much different because we had the steep decline, but we're seeing the markets and some of the investments, claw back some of that loss?
Yeah, that is a little bit different because don't forget, during the Great Recession, the recession started in December of 2007 and went all the way through until June of 2009. In this case, as I just said, we went the quickest bull market, bear market, bull market scenario. What we're going through right now, and it hasn't been official yet, the recession that we're in, we could be out of it already and not even know it.
Yeah. So
this has happened so quickly, as you said, that I think that the way things that happened back then, it was obviously, from 07 to 09, that, people's heads just spun and all of a sudden here we are investment-wise. But let's not forget, we have this disconnect between Wall Street and Main Street, right? To the like that I've never seen before, where you have the market that's looking forward and always does look forward to people shaking their head and saying, hey, how many 20 million plus people are unemployed, and yet the stock market's hit all-time high.
Right.
So I think people would be looking at the retirement scenario, or they're being forced into retirement just because of the COVID that, of course, didn't exist back in the Great Recession. And a lot of those businesses came back in 2008, 2009 and 10 and 11. We know that a lot of these small and mid-sized businesses aren't coming back.
Yeah. We're joined by Tom Meyer, who is the CEO of Meyer Capital Group. All right. So, Tom, every time we get news that pops up on one of the big pharmas that has, gotten an advance in terms of their testing on a coronavirus vaccine, we see the markets pop up. They heat up really, really quick. When we get to a point where we actually have a vaccine that will be distributed, or a couple of vaccines, how's Wall Street going to react? Is it going to be an even larger increase?
Let me get my Ouija board out. Let's see. Okay, this is what's going to happen, in my opinion. It's going to be buy the rumor, sell the news, and I think that what's worked now, if that does happen and we get that virus, that is when you really want to go into those cyclicals and materials, because that's where you have what we call the recovery stocks. They got a big push and then ultimately petered out. So I think that is going to be what's going to push this market forward after we get. Now, personally, I would love to see a therapeutic before we even see the vaccine. I think that will do a lot for confidence in the economy. But I think that's the way it's going to work out, that all these stocks that are working right now are the ones that will be sold to rotate into the ones that, the 3Ms of the world and the railroads and the transportations of the world and the materials of the world that are very cheap right now, I think will ultimately be the place you're going to want to be.
How's this, do you think, how's all this going to impact your industry specifically?
Oh, there's so much impacting our industry right now. I mean, thank God for technology, right? How about a little pat on the back to the Comcasts and the Verizons of the world that thank God that, this wasn't 10 years ago and all the outages that we had for the internet, that the internet providers have done one heck of a job. And from our industry, thank God, the firms that have what we call the business dislocation method, the scenario of, hey, we know after 2001, after 9/11, hey, we want to make sure that we have a business disaster recovery, and we were all set up for this, and we were able to do this anywhere. I mean, we have a skeleton crew here. Everyone's working from home as they have been. So our industry really hasn't been as disrupted as, unfortunately, other industries. We've been very, very lucky. But as far as think about the merger with TD and Schwab, as costs come down, which is great for the individual investor, fees are coming down. So I think it's a boom to individual investors, and firms, investment firms and big brokerage firms have to get used to the new world, and they have to adapt, be flexible. Otherwise, their margins are just going to decrease each year.
Tom, as always, great to talk.
Interesting for sure.
Yeah, Tom, as always, great to talk with you. Be safe, and we will catch up with you again soon.